A lot of banks just don't understand the real estate investment space. So listen, if you got a lot of cash and you want to put a big down payment to get cheaper money on your real estate flips, go for it. If you have that ability, they're a great option. Cool. Let's get that out of the way. Let's talk about why. Well, first off, like we talked about in an earlier video a few weeks ago, banks want to deploy money in bulk. Hundreds of millions, billions of dollars. The real estate investment space is just not a big enough space for them to begin with, especially in $150,000 increments. And more importantly, they hate servicing loans, especially ones with a construction component on it. So you're kind of, they can't give you advice on these deals. They don't know it. They know finance. That's about it. That's all they care to do, right? You need a local expert, a hard money lender, somebody who's also a real estate investor, the person that's lending you the money. And a private lender isn't a good source either, because a private lender is probably just some sort of just looking to passively get a good return on their money.
Not enough experience.
A hard money lender is a full-time profession. This is what we do. We buy real estate. We lend money on real estate on a full-time basis. Every day we're working on transactions. We're working on loans. This is what we do, and that is why working with a hard money lender is pretty much the number one way to get financing for your deals.
Yeah, I find what Jay's saying, it's almost like we're also called bank, right? Hard money bankers, hard bank. We operate in two different worlds. We really do. We intimately know the investments, the markets we're in. I intimately know, the Philadelphia market, the counties around it, the South Jersey market. I can tell you streets, blocks. Jay knows Northern Virginia, DC, Maryland.
Subdivisions. Everything.
Your bank is not going to know that. It's not the market they're truly in. They're in retail. They're more towards retail, and they dabble in investment. We are in investment. I don't know anything about retail, to be quite honest, but I do know about investment properties, and there is a huge distinction there when you're dealing with flips or making serious money on projects. So you want to make sure that you're putting the information into the right box, whereas a bank is not the right box for an investment purpose. We are.
Let me interrupt with one really interesting thing to think about.
Sure, yeah.
If you go to a bank and your credit is not the best, and you have a property worth $500,000, there's a lot of properties like that in our market, and you want a loan for $100,000, and you don't have perfect credit, and more importantly, you don't have financial statements or tax returns to prove, your income, that deal is out the door.
Yeah.
Right?
Not for us.
That deal is out the door for a bank.
Yeah.
Right? They're out of it, and more importantly, even if they felt like it's a good loan on their balance sheet, a regulator would come in and be like, yeah, this deal doesn't work. We just don't get it. Like, we don't want to deal with that credit. Mm-hmm. Right? They'll call it crappy paper or whatever the case is. That deal's great as a real estate investor. That deal's great for a hard money lender. We look creatively. When someone says, what is your credit score requirement, what do you tell them?
I tell them, what's the asset look like? I mean, I don't even address it. What's the asset look like?
Nope, you have a 699, not a 700. Sorry, turned down.
Yeah.
That's just that. Yeah, the answer is this. Obviously, there is a formula related to credit, and from experience, we have noticed that borrowers with lower credit sometimes pay late, and sometimes they potentially be default a little bit worse. That being said, that doesn't mean we're not going to write a loan for them. Maybe they need an extra 5% into the deal instead of a borrower with better credit. But at the same time, the deal's masked. And we're going to talk about this in next week's video, but the deal is masked related to the four C's of underwriting, mm-hmm. which is collateral, character, capacity, and credit, credit being number 4. So in our next video, we're going to talk about the 4 C's of underwriting so you truly understand it.
Perfect.